Recent headlines from Minnesota tell a story of misallocated funds, ghost daycares, and a sprawling investigation into billions of dollars intended for children. It's a complex situation with conflicting reports, creating significant public confusion. But if we zoom out from the specifics of any single event, we can see that stories like this are symptoms of a much larger, less visible economic reality. This isn't about one program or one state, it's about the immense and growing pressure on public financial systems. When any large, complex system is put under enough strain, it will start to leak. The debate often focuses on those leaks, the funds that go missing. But the biggest leak of all is the one quietly draining the purchasing power from everyone's savings. This is a story about two kinds of taxes, the one you see and the one you don't. Every taxpayer-funded program, like the Child Care Assistance in Minnesota, is supported by what we can call a visible tax. This is the money you see deducted from your income and paid at the register, an explicit and quantifiable cost for public services. With thousands of such programs, the federal government becomes a vast machine for transferring money. In any system of this scale, involving trillions of dollars and complex layers of administration, there will inevitably be points of failure. These can be inefficiencies, errors, or outright abuse. Such leakage is not necessarily a political issue, but a systemic one. The more complex the plumbing, the more places it can break. These leaks can be substantial, with hundreds of billions lost from federal programs each year. But this visible system of taxation and spending runs parallel to a much larger, quieter force, the invisible tax of inflation. When government spending is financed through debt and the expansion of the money supply, the value of every existing dollar is diluted. This erosion of purchasing power is a tax that is never voted on, but it affects everyone. Think of it this way. Visible taxes are like someone taking a slice of your pizza. You see it happen. Inflation, on the other hand, is like the pizza itself shrinking while you're not looking. The headlines are about a fight over the slices, but the more fundamental issue is the shrinking pizza. This distinction, visible taxes versus invisible ones, is one of the most misunderstood parts of modern economics. If this way of thinking is new to you, I actually break it down step by step in the first free module of my macro investing course. It's designed to help you see the system clearly, without politics, hype, or fear. You can watch it for free. Links in the description. Individuals and families experience pressure from both sides. They pay visible taxes for programs that may be inefficient, and they simultaneously lose wealth to the invisible tax of inflation, which quietly reduces the value of their savings and wages. From a systems perspective, immense pressure creates powerful incentives. When large pools of capital are managed by complex rules, some individuals will inevitably respond to the incentive to exploit those rules. This is less a moral story and more a predictable feature of human behavior within a given system. The Feeding Our Future case in Minnesota is one example of how these incentives can manifest under pressure. But this adaptation isn't limited to a few bad actors. When economic pressure becomes too great, people don't always protest in the streets. They make quiet, individual adjustments to protect their financial well-being. They move to lower tax jurisdictions, change how they work, or seek out alternative ways to store their wealth. They begin, in small ways, to reduce their exposure to systems they perceive as increasingly inefficient. This is a natural human response to systemic pressure. This quiet process of opting out eventually leads to a search for a true escape valve, a way to preserve wealth outside of the traditional system. Historically, people have turned to assets like real estate or gold to shield themselves from currency debasement and instability. Today, a new option is emerging: Bitcoin. It's important to view this not as a political statement, but as a response to the current monetary mechanics. At the institutional level, we've seen this same shift play out quietly, as central banks and regulators have begun to classify Bitcoin not as a currency, but as a digital store of value. It is a decentralized mathematical system that operates with a fixed supply, making it inherently resistant to the shrinking pizza problem of inflation. Because it is not controlled by any single government or institution, it offers a neutral, borderless way for individuals to preserve their purchasing power and maintain financial mobility. It is an asset built on a network of code and consensus, rather than on trust in political or financial authorities. This is not about short-term price speculation or getting rich quick. It's about long-term monetary optionality. It is an alternative savings technology for an era where trust in conventional financial systems is being tested by immense pressure. It is a lifeboat, not a lottery ticket. While headlines often fixate on political battles and specific scandals, the underlying economic mechanics operate silently in the background. The visible leaks in complex government programs are symptoms of a much broader systemic pressure. The truly universal challenge is the steady erosion of purchasing power, driven by the combined weight of visible and invisible taxes. Inflation is not just an economic data point. It is a force that quietly confiscates wealth over time. Understanding these systems is the first step. The goal isn't to react to headlines with fear, but to understand the larger forces at play and to make rational, forward-looking decisions. In a world of increasing complexity and financial pressure, preparation beats panic.